Do you want to start investing but don't know where to begin? Are you overwhelmed by all the different strategies and advice out there? What if I told you that you don't need a degree in finance to get started? You just need a simple plan, a bit of patience, and the right approach to make your money grow. In today's video, we're going to dive into 8 beginner investing strategies that actually work. Whether you're looking to start with small steps or you're hoping to build a long-term wealth strategy, these methods are straightforward, risk-managed, and perfect for those starting out. By the end of this video, you'll know exactly where to begin with your investment journey. So let's get into it. 1. Passive index investing. Let's kick things off with a classic, passive index investing. What if I told you that one of the best ways to invest is to simply match the market instead of trying to beat it? Sounds easy, right? Instead of gambling on individual stocks, you can invest in a fund that tracks a specific index, like the S&P 500. This gives you instant exposure to hundreds of companies across different industries, which makes it safer, especially for beginners. Think of it like a big basket with small chunks of all your favorite companies. The key here is that the market, over time, tends to grow, and by matching its performance, you're also likely to see growth. Best platforms for this strategy? You can check out Vanguard or Fidelity. These are perfect for hands-off investors who want to see long-term growth with minimal risk. Not only is it an easy strategy to follow, but it's also one of the most widely used by seasoned investors who believe in the power of long-term, steady gains. 2. Dollar cost averaging, DCA. Now, let's talk about a strategy that helps you sleep easy at night, dollar cost averaging, DCA. You might be wondering, what's the best time to invest? The answer: all the time. With DCA, you invest a fixed amount of money at regular intervals, like $100 a month, no matter if the market is high or low. This way, you don't need to worry about timing the market. Over time, this approach helps smooth out your average cost and can protect you from making emotional decisions when markets fluctuate. Essentially, it takes the pressure off because it helps you stick to a consistent investment plan. Plus, it reduces the chances of buying at the wrong time, such as when the market is at a high point. It's a fantastic strategy for those who don't have a lot of time to keep up with market trends but still want to take advantage of compound growth. This strategy works especially well for retirement savings or other long-term goals, where you don't need to worry about short-term fluctuations. 3. Buy and hold. If you're the type who prefers to set it and forget it, then buy and hold is the strategy for you. The idea here is simple: buy high-quality investments, like ETFs or blue-chip stocks, and hold on to them for years or even decades. The key to this strategy is compound growth. Instead of panicking when stocks dip, you simply hold on and let your investments grow steadily over time. This is a classic strategy that works wonders in the long run. You'll see that the real power lies in giving your investments time to ride out short-term market swings and gain from long-term trends. It's one of the most reliable strategies for building wealth over time, especially if you're investing for retirement or another distant goal. Historically, the longer you hold on to investments like stocks or ETFs, the better your returns tend to be, making this strategy particularly effective for patient investors. 4. Dividend reinvestment, DRIP. Do you want a strategy that works even when you're not actively doing anything? Meet dividend reinvestment, DRIP. This strategy involves investing in companies that pay dividends, basically, a portion of their profits returned to you as a shareholder. By enrolling in a DRIP, your dividends are automatically reinvested into more shares, so your investment grows without you having to lift a finger. It's like setting up an automatic savings plan, but for your investments. Over time, those small, regular dividends can buy you even more shares, which means more dividends the next time. This compounding effect can lead to significant growth over the years, especially if you're reinvesting for a long time. It's perfect for those who want to grow their wealth passively while also enjoying the rewards of a steady income stream. This strategy works especially well for people who are not looking for immediate returns but rather long-term growth, such as investors saving for retirement. 5. Fractional share investing. Let's talk about fractional share investing. Ever wanted to own a piece of a company like Amazon or Tesla, but thought you needed thousands of dollars? Think again. With fractional share investing, brokers like Robinhood or Charles Schwab allow you to buy fractions of shares for as little as $1. This means you can invest in high-value companies with a tiny budget and still create a well-rounded, premium portfolio. It's a game-changer for beginners who want exposure to top companies but don't have the big bucks to spend. By buying fractions, you get to diversify your investments more effectively without needing a lot of capital. This strategy also opens up opportunities for people who want to target specific companies but can't afford whole shares. It's perfect for those just starting with small amounts but who want to aim high with their investment choices. 6. The core and satellite approach. Here's a strategy that gives you the best of both worlds, the core and satellite approach. The idea is to put 70 to 80% of your money into safe, diversified index funds, the core, which will protect you from volatility. Then, take the remaining 20 to 30% and invest it in more exciting, riskier assets, the satellite, like individual stocks or niche sectors. This strategy helps you balance safety with the potential for high returns from riskier picks. While the core provides stability, the satellite gives you the chance to take advantage of new opportunities or high-growth companies. It's like combining the security of a safety net with the thrill of a few high-flying investments. This strategy is fantastic if you're someone who likes the idea of having a strong, stable foundation while still taking some chances. It also works well if you're interested in sectors or companies that could see explosive growth, but you're not ready to put all your money at risk. 7. Income investing. If you're someone who wants to generate regular cash flow, then income investing is the way to go. This strategy focuses on assets that provide consistent payouts, like bonds, REITs, real estate investment trusts, or high-yield savings accounts. It's perfect for those who want a steady stream of income rather than waiting for long-term capital appreciation. Plus, seeing those payouts hit your account can feel pretty rewarding. Unlike other strategies that focus on capital gains, income investing gives you the advantage of having real, tangible returns that can support your everyday needs or reinvestment efforts. This approach works especially well for those looking for less risk but still wanting to see tangible results. It's ideal for investors who are more interested in cash flow than growth and want more security in their investments. 8. Value investing. Last but not least, we have value investing. Inspired by the legendary Warren Buffett, this strategy focuses on finding stocks that are undervalued, companies that are selling for less than what they're worth. While it takes a little more research than other strategies, it can lead to great returns in the long run. Imagine picking up a high-quality company on sale before everyone else catches on. That's what value investing is all about. It's like shopping for a good deal on items you know will increase in value as time passes. However, this strategy requires more due diligence and a keen eye for spotting undervalued gems in the stock market. Before you dive in, it's important to study the company's fundamentals, such as earnings, debt, and future growth prospects. Value investing can be incredibly rewarding if you're willing to put in the time to research and understand the market's hidden opportunities. So, there you have it, 8 beginner investing strategies that actually work. Whether you're looking for simplicity, steady growth, or a little more risk, these strategies are designed to help you take control of your financial future. Remember, the best time to start investing is now. And no matter which strategy you choose, consistency is key. Start small, stay patient, and watch your money grow over time. If you found this video helpful, make sure to like, share, and subscribe for more easy-to-understand tips on growing your wealth. Happy investing, and I'll see you in the next video.